Welcome to the Research Desk. The era of overvaluing digital scalability and underpricing physical infrastructure is dead.
It is completely over.
Today's mission is to unpack the source document, why physical moats rule the AI era, and reveal why the pendulum has aggressively swung back to the tangible physical world. For you listening right now, understanding this massive shift from bits to atoms is absolutely critical.
It is the defining shift of this decade.
Right. If you want to grasp the true choke points of the current AI boom, you have to look past the code and look at the concrete. We're looking at a fundamentally altered landscape here.
That is correct. And there is absolutely no ambiguity about the impact of this shift. The macro environment we are witnessing right now is driven by three distinct structural forces.
Okay, let's break those down.
First, we have what is known as the ZRRP distortion.
ZRRP meaning zero interest rate policy.
Precisely. The premium on intangible asset-light businesses was purely a low interest rate phenomenon. For roughly a decade, money was essentially free to borrow.
Right, you could get funding for almost anything.
And that anomaly placed a massive artificial premium on software. You could scale software infinitely with almost no penalty because the capital to do so was free. That era is definitively over.
Yeah, when money isn't free, suddenly those companies that only exist in the cloud have to face some hard economic gravity.
The cost of capital has returned to reality. Which brings us to the second force. AI's tangible demand.
Because AI is incredibly heavy, right? It's not just algorithmic magic floating in the ether somewhere.
It is not. Artificial intelligence requires unprecedented, massive, power-hungry physical resources. It is concrete, it is steel, it is specialized cooling systems, and massive, massive amounts of electricity.
It requires a physical footprint that just completely dwarfs previous technological revolutions.
And that reality leads directly into the third force, which is a permanent structural shift towards supply chain sovereignty.
That's the shift away from the just-in-time global manufacturing we've relied on for so long, right?
Yes, the transition from just-in-time efficiency,
where parts arrive exactly when you need them.
Exactly. Moving from that fragile efficiency to just-in-case resilience is now permanently locked in. Geopolitical tensions have proven that relying on a perfectly optimized global network is a massive vulnerability.
So nations and corporations are physically securing their own supply chains, building redundant, localized infrastructure.
The market is fundamentally repricing reality. The premium is moving from those who write the code to those who own the physical choke points.
Here's where it gets really interesting, because this kind of physical hegemony is now acting as an irreplicable toll gate. If you control the atoms, you control the bits.
You literally cannot run the software if you cannot access the hardware.
And we're seeing this perfectly illustrated with the TSMC fortress.
Taiwan's Semiconductor Manufacturing Company, or TSMC, is a premier example of this new paradigm. Let us look directly at the financial realities.
The numbers are staggering.
They are. Despite an enormous capital expenditure of $30 to $32 billion annually, TSMC maintains a 21% return on invested capital.
Just to pause on that for you listening. A 21% ROIC at that physical scale is almost unheard of.
It is phenomenal efficiency.
Right. It means for every dollar of that $30 billion they pour into building massive fabrication plants, they're generating 21 cents of profit on it.
And alongside that, they maintain massive 40 to 42% operating margins.
Which they can command, because building those plants is so impossibly hard.
Exactly. Replicating their fabrication facilities carries a functionally infinite cost. It is not merely a matter of a competitor raising $30 billion.
Because even if you had the money, you can't just buy your way through the red tape.
You cannot. The severe regulatory approvals, the environmental impact studies, the water rights, and the sheer land use barriers make duplicating their infrastructure practically impossible today.
They have built an unassailable physical moat.
The facility itself is the monopoly.
Which actually reminds me of the railroads. We've seen this kind of toll gate before. Think about Union Pacific.
It is a perfect historical parallel.
Right. Because the reason a railroad company like Union Pacific commands a price-to-book ratio of 10.0.
Meaning the market values it at 10 times its actual assets?
Exactly. It isn't because they have some incredible proprietary routing software. It is simply because its transcontinental railway network is impossible to duplicate.
You literally cannot go out and buy that continuous, unbroken strip of land across the United States today.
You can't get the zoning. You can't get the right-of-way. The physical asset itself becomes the ultimate monopoly. But as we look at the AI boom today, It seems like the bottleneck isn't just about the silicon anymore.
No, the bottleneck is migrating. It is moving away from silicon fabrication and directly into the power grid itself.
So we are entering what the source calls the compute industrial complex.
Raw grid interconnection is the new limiting factor. It is about whether you can physically generate and route enough electricity to power the chips.
Which introduces this concept of the temporal moat.
Yes, a barrier to entry based entirely on time.
Because you can't software engineer your way out of a 4 to 7 year grid permitting timeline?
You absolutely cannot. Nor can you bypass the 120-plus week backlogs for manufacturing high-voltage transformers.
Over 2 years just waiting for a power transformer.
Time and physical constraints are the ultimate unyielding barriers to entry.
Which brings us to perhaps the wildest example of this power scramble we've seen recently. Tech giants are realizing the public grid cannot sustain them.
So they're securing their own baseload generation.
Microsoft just signed a 20-year power purchase agreement to literally restart the 3 Mile Island nuclear reactor.
That represents a profound pivot in the market. A software company securing a 2-decade agreement to bring a dormant nuclear facility back online.
Just to feed its AI data centers.
We define this aggressive maneuver as the SpaceX moment.
Explain that connection. How does a software company buying a nuclear plant connect to SpaceX?
It is the moment where radical vertical integration collapses costs and bypasses traditional bottlenecks entirely. SpaceX realized they could not rely on the stagnant aerospace supply chain.
So they built the rockets and engines themselves.
Today, technology giants are having their own SpaceX moment. They are vertically integrating into baseload power generation because they cannot rely on a constrained public grid. Control the power, control the AI.
So what does this all mean? We're talking about massive, unprecedented investments in physical infrastructure, billions on chip plants buying nuclear reactors.
It is incredibly capital intensive.
Right. Is there a dark side to all this capital intensity?
The dark side is severe, and it is entirely real. We call this the Sisyphus treadmill.
Like Sisyphus pushing the boulder up the hill only for it to roll back down.
Precisely. Heavy capital intensity frequently masks a terminal value trap. When a company relies on massive fixed assets, they can be forced into a position where they must spend continuously just to survive.
Just running on an endless treadmill to maintain their market position.
And we must look at the historical precedents because we have seen this exact dynamic before. Look at the 1840s railway mania in the United Kingdom and the 2001 fiber optic glut.
Let's break those down. During the railway mania, massive investment poured into building train tracks all over Britain.
Yes. And during the dot-com bubble, telecom companies laid millions of miles of fiber optic cables across the oceans.
And in both events, the outcome was identical, that the infrastructure survived.
The train tracks were used for a century, and the fiber optic cable successfully carried the world's internet data. The physical assets were fundamentally necessary.
But the equity of the companies that built them was entirely wiped out.
The builders went bankrupt. They took on too much debt to build assets that became commoditized. The builders died while the subsequent users reaped all the economic benefits.
That is a terrifying prospect for modern investors looking at the AI boom. It brings up this massive issue of stranded asset risk.
It is the ultimate vulnerability today.
Imagine you build a state-of-the-art $100 billion data center. You optimize the physical architecture, the cooling specifically for today's NVIDIA H100 chips.
If new algorithmic efficiencies suddenly reduce overall compute requirements, that $100 billion physical asset could face instant obsolescence.
It becomes a stranded asset, a very expensive monument to yesterday's technology that you are still paying off.
So you must understand the crucial difference between the Lindy effect and the depreciation trap.
The Lindy effect suggests that certain robust structures prove their resilience and actually increase in life expectancy the longer they survive.
Applied to physical moats, it means the asset actually becomes more valuable over time. Look at Amazon's massive physical delivery fleet and warehousing network.
Right. That fleet cures what we call separation anxiety between the consumer and the physical product.
By owning the delivery vans and the distribution centers, Amazon created an infrastructure that is deeply entrenched. Similarly, look at Japan's Monozukuri tradition.
Monozukuri, which roughly translates to the art of making things.
Yes, their deep culturally ingrained commitment to manufacturing excellence. Over decades, that tradition built an irreplaceable engineering grammar in Japan.
It's a human capital moat that compounds in value.
And it cannot be quickly copied by simply throwing billions of dollars at a new factory.
But on the flip side, we have the depreciation trap, where capital constraints become an anchor We see this in the steel mill paradox.
United States Steel had massive, sprawling, fully integrated legacy facilities. They looked unassailable.
But they were completely bypassed and disrupted by nimbler mini-mills.
Mini mills utilized new, highly efficient physical footprints to melt scrap steel at a fraction of the cost. The massive infrastructure of U.S. steel became a depreciation trap.
And we see this exact paradox in the tech world, too. For decades, Intel's sprawling physical labs and fabrication plants were their greatest competitive advantage.
But when the manufacturing paradigm shifted, those massive plants morphed into rigid constraints.
They became anchors that slowed the company down, while Fable's competitors like AMD outsourced to TSMC and just pulled ahead.
It is the classic depreciation trap.
Okay, let's unpack this, because to make sense of all this, there's a specific historical archetype that perfectly captures this dynamic between the software developers and the hardware owners. It's called the chef without a kitchen.
The chef without a kitchen is the definitive analogy for this current technological era.
Software is the recipe, right? It holds the algorithms and the digital logic.
It is highly valuable intellectual property. But true sovereignty, the ultimate power and the ability to capture real economic value, belongs to whoever owns the stove.
That paints such a clear picture. You can have the greatest Michelin star recipe in the world, but if you don't own a kitchen to cook it in, you can't serve a single plate.
You are entirely at the mercy of the person who owns the physical infrastructure.
If the kitchen owner decides to double your rent or prioritize another chef, you have no recourse.
Right now, many pure software companies are realizing they are just chefs renting space in someone else's very expensive, power-hungry kitchen.
Which is why the tech giants are fighting so hard to own the stoves. Beyond the chef analogy, there are a couple of other historical archetypes, like the medieval castle.
Which represents the reality that capital-heavy fortresses that take years to build are historically the only things that actually survive long, grueling economic sieges.
And we also see the Fitzcarraldo struggle, named after that Werner Herzog film, where a man hauls a massive steamship over a steep hill in the jungle.
It represents those agonizing, insanely capital-heavy struggles that eventually create enduring monuments of immense value. Building an advanced semiconductor fab today is a Fitzcarraldo struggle.
It definitely sounds like one. So we have these massive centralized physical structures dominating everything.
Yeah.
But there is a massive curveball in how physical moats can be built today.
The wild card in this entire transition is DePIN, Decentralized Physical Infrastructure Networks.
It's a radical structural alternative to traditional infrastructure ownership. Break down how DePIN actually works for the listener.
DePIN utilizes a distributed balance sheet. Instead of one centralized corporation taking out billions in loans to build a nationwide network, the network is crowdsourced.
It deploys massive physical networks by uniquely utilizing the capital and physical real estate of thousands of individual participants.
Yeah. Two explicit examples are Helium and HiveMapper.
Helium is building a global wireless telecom network just by having individuals plug small hotspot devices into their home internet, right?
And HiveMapper is mapping the entire world by having gig drivers put specialized dash cams in their cars.
They achieve these incredibly asset-heavy results by distributing the physical hardware costs across millions of people.
It is a brilliant structural bypass, a completely unique way to build an irreplicable physical moat without ever stepping onto that Sisyphus treadmill of crushing corporate debt.
It entirely flips the script on who owns the assets. But whether a company uses DePIN or goes the traditional capital-heavy route like TSMC, how should we look at the market?
The ultimate goal requires entirely rejecting the old binary. Neither asset-light nor asset-heavy is inherently a moat by itself.
Because being overly asset-heavy can destroy you.
Exactly. The authoritative paradigm today is to be asset-right.
Asset-right, meaning you own the exact choke point where the physical atoms constrain the digital bits.
You want to own the specific toll gate everyone else must pass through. That is where the premium lies.
So how do you actually identify an asset-right choke point? We have a triple filter of authoritative metrics to spot these true physical moats. First up is the ROIC versus WACC spread.
Return on invested capital versus weighted average cost of capital. You need to see a spread between those two numbers of greater than 5% sustained over a 10-year period,
proving they generate real sustained value above what it costs them to borrow money. Second, the replacement cost of their physical assets must be strictly greater than 3 times their book value.
This proves the infinite replacement cost theory we discussed earlier. Third, the useful life of the physical asset must span more than twice the length of the prevailing technological cycle.
So if a new chip generation comes out every 2 years, your fab plant needs to be useful for at least 4 or 5 years.
Preferably decades. This metric actively protects against the stranded asset risk.
And finally, there must be temporal scarcity, a massive premium for any asset that takes more than 5 years to physically replicate.
Because you cannot print time. This framework demands very direct, unhedged portfolio actions. First, target power infrastructure companies that have successfully locked in power purchase agreements at less than 5 cents per kilowatt hour.
Energy is the new oil of the AI era. Cheap long-term power is a massive advantage. What specific numbers should we screen for in manufacturing?
You are looking for a capital expenditure to revenue ratio greater than 15%.
Showing they are seriously investing in physical scale.
You want operating margins strictly greater than 25% and an incremental ROIC greater than 15%.
Meaning every new dollar invested generates high returns. Which companies meet this?
The companies explicitly meeting these stringent criteria today are TSMC, ASML, and CATL.
But to ensure they aren't caught on the Sisyphus treadmill, we need to look at maintenance right.
Yes, you must ensure their maintenance Capex is less than 30% of their EBITDA.
So they're spending their cash building new profitable castles, not just hatching leaks in the roof of old decaying facilities.
Maintenance Capex under 30% proves they are expanding their moat, not just surviving. The final aggressive move demanded by this shift is to short pure-play SaaS companies that rely entirely on third-party clouds.
The logical conclusion of the chef without a kitchen analogy.
If a SaaS company is entirely dependent on someone else's data center, someone else's power grid, and someone else's silicon, they have absolutely no sovereign physical moat.
They are completely exposed to rent hikes. They are the most vulnerable players on the board. For you listening, this really pulls the curtain back on the whole tech industry.
It reveals the true power dynamics.
It makes you reflect on how these invisible physical toll gates dictate the digital tools you use every single day. Every app, every AI prompt, it's all waiting in line at a physical bottleneck somewhere.
Which leaves you with a critical strategic question to analyze moving forward. If software is truly just the recipe and the ultimate economic power lies solely with the owner of the physical stove, what other overlooked stoves in your own industry or your daily life are quietly amassing unassailable, irreplicable value right now?
The choke points of the next decade are being poured in concrete today. This is the research desk officially signing off.